James, welcome to the first podcast of 2013. To begin with, how did the Harmony range fare during January?
January was a good month overall. Saw a continuation of the sort of positive impetus we saw in markets for much of the second half of last year, of the year 2012. And yeah, as a result, in this risk-on sentiment, the Harmony funds did pretty well. All of them provided a positive absolute return, and with only one exception, all the funds beat their benchmarks as well. So a pleasing month insofar as it really saw all of the different potential drivers of performance in the portfolios really firing together, which is always pleasing.
Speaking to performance then, what would you say were the main asset allocation drivers during January?
Well, the obvious one is the equity markets. They were the standout performing asset class over the month. A return of positive sentiment really drove those markets forward as a number of different economic factors came together, but particularly we seem to have at least a stalling of the issues regarding the US fiscal cliff. It's really been sort of kicked down the road quite impressively by the US government in the sort of dying embers of last year. We moved the funds to overweight equity in the sort of final couple of months of last year. We thought the markets would do a little bit of a sort of bounce into the start of this year, and consequently our asset allocation positions benefited performance through that. The other main position we were, and we continue to be, is underweight global government bonds and the highest quality end of the fixed income spectrum. Pleasingly, that part of the market sold off in January. We've seen a number of months historically where, although the equity markets have done quite well, bonds have done quite well as well. So that historical interrelationship between these asset classes, where if equities are doing well, you generally expect bonds to not do so well, haven't really occurred. And in those circumstances, the performance drivers have been less obvious in the asset allocation process. But in the month of January, saw a return to what you might think of as a more normal interrelation between those asset classes. And so by being overweight equity and underweight fixed income, at least the high quality end of the fixed income spectrum, the funds did well. We continue to be underweight global property securities. We still think they're expensive. We have mitigated that slightly by adding a holding in listed infrastructure securities to sort of augment that property holding, bring us back to neutral, if you like, for property-like instruments. And they perform broadly in line with the property market, so that sort of neutralised that position. And then finally, coming back to fixed income, while government bonds and the high quality part of the bond spectrum didn't do particularly well, there are still positive returns to be had in the fixed income markets. Areas like high yield, convertible debt, and strategic bond managers all provided low single-digit returns for investors over the month.
Good stuff. So both sides, let's say the asset allocation decision to work there, long equities, short to an extent government bonds. Did you elect to make any major changes last month to the portfolios?
I think we said last time, it's the changes recently been quite evolutionary, and I think the same would be the case in January. The main change was to move from an overweight position in equities down to neutral, so just shave off those profits we've made essentially in the equity portion. The main reason being, I think if we cast our mind back to last year, talking about the markets, the absolute key thing to always bear in mind is that market performance is not directly related to economic performance. And that's the case last year when times seemed bad economically, and it's also the case today while times seem positive. Again, we need to try and look through that short-termist noise, if you like, and look at something fundamental that we can really hang our hat on. So last year, as Europe looked like it was on its knees about to break up, that actually provided some decent valuation opportunities as markets drifted off, or fell off in fact. Some quite bad returns in a number of days over that period. And likewise today, while economically things seem a bit more certain, Europe looks to be, while still having problems, it's a secure unit for now. US seems to be in a better position fiscally in the sense that they've at least pushed out the issues they face on the fiscal cliff and the debt ceiling, and they certainly don't have that immediate 4%-ish kick-off GDP that we were expecting were the fiscal cliff to have not been sorted out somehow at the end of last year. China looks okay. There were some worries about how fast a rate of slowdown China would experience, but it looks to have stabilised now. And then finally, Japan looks in reasonable shape as well. So there's a lot of reasons on the surface to be positive, but again, we mustn't lose sight of fundamental valuations. And with equity markets moving double digits from the middle of last year, earnings haven't kept up with that, although the corporate sector is in good shape, and it's worth, I think, just being a little bit circumspect in the coming months. One of the key themes that everyone's been talking about recently is the Great Rotation, this move from massively overweight bonds to sort of dipping a toe or even aggressively taking positions in the equity market. And while I think there's some truth to be found in that, it's worth just taking a step back and just being circumspect based on what's been going on over the last few months. Positive sentiment is clearly welcome, but where that turns into complacency, I think that's when we become anxious, and there are still plenty of risks out there. While Europe is in better shape, it's still not completely sorted. There's a lot of fiscal consolidation of some sort that needs to be undertaken there. That takes probably 10 years to happen. The US needs to do something about their fiscal balance. Hopefully Japan is sorting itself out, and hopefully China's in reasonable shape. But the point is that while today we're confident, we mustn't lose sight of the risks that are in the background still.
So James, markets have made a good run, equity back to neutral as a result. With everything you've said there, what do you see for markets in the near term then?
I think two main key themes. The first one, on the fixed income side, we remain underweight there. We think that interest rates will in time move out, particularly on the high quality end of the fixed income spectrum. Therefore, you're likely to start suffering losses of some sort from the capital part of the fixed income equation, even if you still continue to get income from it. What's worth bearing in mind though is we don't think it's going to be a short, sharp shock of a move in interest rates. It's likely to be a drift out. So there's still value in fixed income in portfolios, but overall we think that on the higher end of the quality spectrum there's less attractive opportunities there. In the equity markets, it's worth perhaps moderating what I was talking about earlier, or giving some context in terms of the risk of equity investment. We're still broadly constructive on equities over the medium term. We just think in the short term the market's due a bit of a pause, and it's worth bearing that in mind. Over the coming year or so, we expect to see a continuation or a repeat of what we've seen recently, which is this drift up generally in equity markets, but with a sawtooth profile. So there will be shocks along the way, bumps in the road, and the key really for investors is genuine diversification to try and mitigate the impacts of those bumps when they happen. And also, of course, when the more severe bumps happen, they do provide an opportunity for valuation-driven investors to get into the market. So remain diversified and keep an exacting focus on valuations, because while it's difficult to get in the markets when sentiment is poor, that generally proves to be the right time. So a critical focus on valuations and diversification in portfolios should do us well this year.
James, thank you very much.
Thanks, Richard.